Without further ado, we're about to bring in Tech Trader for our Trader Talk segment today, and that means Sean Udell will be joining us. What's up, Sean?
Correction's over.
Oh, is it? So you're placing your flag in the ground right now, and the correction is over. Calling it from you,
Well,
right?
that sounded good to start the show.
All right. So you're lying to us right off the bat.
No, I mean I kind of alluded to it yesterday in my note. I mean I covered my Apple short. Um, so took off some yeah, and it didn't cover any cloud shorts. But took off some other short exposure. So I basically bought because I bought to cover yesterday. Um, so I don't love the rally. I can't say I love this rally. I'm kind of paging through things right now. A lot of cloud stocks up. It's basically the kind of the typical suspect type rally. It's basically a redux of all the FANG rallies last year, which we talked a bunch of times about how the FANG rallies were not very healthy, and ultimately concluded in a really really nasty correction. So it's basically the same setup. It's you got people chasing cloud stocks instead of FANG. And that seems to be the thing that people want to at least the aggressive traders. I don't know if they're the best traders, but the most willing to buy dip traders, which means they're probably the worst traders actually. So are buying the cloud stocks over and over again. So it's the same deal. If the rally broadens, we get some participation. Other groups go up. Other value oriented things participate, rally becomes healthier and more sustainable. If it's basically another FANG rally, i.e. cloud rally, then the upside's relatively short-lived, probably good to raise cash, probably good to look at reshorting at higher highs or at near highs, and maybe taking quicker trades on profitable long trades and things like that. But I think we've kind of morphed into a very similar condition that we had last year. Like all the FANG rallies were basically unhealthy rallies. They didn't last very long. They kind of led to further declines. We had three major corrections last year, third one being the nastiest. I don't know, kind of almost feels like this year's kind of replay of last year so far. Big January move. Okay, so we put correction number one in the books now. And NASDAQ was down almost 7%. So, I said we needed, 400 points minimum on the NASDAQ. We got 550. So condition one completed. I'll close there.
All right. So if we go back down, you're gonna say that, well, yeah, I told you we created or we completed the first correction. Now we're just in another correction.
No, you know me. I'm pretty clear. I mean, if I see another one coming, I'll post it. So I was very clear the Wednesday before last Wednesday. I said, hey, hours to days now from a notable sell-off, and I said again, need a minimum of a few hundred Nasdaqs. We got it. I also don't usually the first correction after a good move higher. It usually is a relatively shallow correction. It would be. I'm sure there is a historical precedent for as bad of a move down we had late year than as good of a move up. I'm sure there's probably a couple times in history where you did have a very severe correction after a V shape like that, but typically that would be unusual. So no, I think we're okay. I just have to. I guess my buying interest will be more predicated on if it's just all cloud stocks being bought and other stuff really isn't doing much, then I'll probably just sit back and wait. I'll probably sit back and either wait to short or my interest in adding further to my existing longs is relatively muted. Doesn't change my current positioning. Still love Twitter. Still love Baidu. Still, any position that, I've made kind of a thesis case for. That doesn't change. Doesn't change that. Still love Redfin. So it doesn't change any of my long-term positioning. Just kind of changes. I mean, I don't know. I think I'm pretty clear on. I mean, you tell me. Is anybody else on the site a Wednesday ago said we're heading for a correction? I mean, I think that was pretty clear. So usually when I
Yeah,
make a
me.
correction call, they're pretty clear.
Yeah, me.
So
I'm
okay, well,
telling you.
good for you. And I'm being as clear as I can that I think we've done enough. I don't think we have to go a lot lower. Um, but I just don't know how good of a bounce we're going to get. Put it that way. And that's I think it's hard to know. I do think there's some pretty good earnings winners, like some really good reports from last quarter that really haven't gone up that much, or they went up and they got repealed. I mean, Twitter. I mean, I was looking at even though I have enough Twitter, I don't really like to buy it a whole lot from unless it's down. I was pretty aggressive buyer of it in the 30 multiple times. And below 37, 38 doesn't excite me that much. I was looking at it yesterday. I mean, I just felt like it had about a 90% chance of rising today. So I could have done that trade. But clipping something for 80 cents, that doesn't excite me a whole lot. But yeah, no. Well, I think, like I say, we did more than the 400. We did 550 Nasdaqs. That's a decent correction. Obviously, anytime we have an index, the correction in the indices, individual stocks fall way more than the averages correct. So a lot of stocks have put in pretty good pullbacks from recent highs or year highs.
All right, so with that said, there's got to be something that's on your shopping list that has pulled back to a decent level that you might be snuffing out.
I actually like Stone Company, STNE. I might even buy more of this today. I swapped my Pinterest for this at a good price. It was trading 29 after hours last night. Super good report. Not really sure why it's only at 56 cents. I mean, they had a big IPO lockup, 51 million shares. It hasn't traded bad since a lockup, but it hasn't kind of done the typical post-lockup burst. I kind of think a burst is coming. Warren Buffett owns this. Not Buffett. Berkshire Hathaway owns this. So yeah, I mean, I'm thinking about 26.50 to 27 on that report. I'll definitely increase this position. Again, this would be an example of a really good report that I still think is viable with notable upside. Now this thing does. I don't know if I put this on briefing, but I had definitely talked or thought that this, 42 to 45, this is kind of nutty. But they almost cut the thing in half off of highs. It's kind of hard to find, 80, 90% growers that are trading at reasonable valuations, and I would say this is one of them. PAGS is another name. They report tonight. I think I like Stone. I liked Pages better before. And that was when Stone was like 35 to 45. Pages was 23. Thought that was the easy trade. But here, I don't know. At roughly the same price, I think Stone's a better asset. Although they're both pretty similar, but Stone's the higher grower.
All right, yeah, I
So
kind of
that's
like.
one. Again, we talked about Twitter. I'll just rattle off. I mean, somebody asked me a question. I mean, I'll address this later. I mean, I haven't really mentioned anything on Baidu because I really haven't. Nothing's changed in my view. So I'm not one to just talk about the same position over and over. If there's, in other words, if nothing changes, I don't have much to write about. I write about like key things or key changes. Once I've kind of made my case, I've made my case. Unless something changes, I don't need to really add to it. But I think people are pretty rational on this. I mean, I actually bought, one of the reasons I built a Baidu position is I thought it would be a relative safe haven. Now somebody might say, well, it hasn't been because it's dropped. Well, on a percentage basis, it's held really well. I mean, it's for my cost, it's not even down 10%, maybe 8 to 9. In a market where lots of stocks, again, any little correction, you get stocks drop 5, 6, 7 times the amount of the indices. So, plenty of other names have dropped 2, 3x what Baidu's dropped. So I think Baidu's kind of done exactly what I want it to do. It's held value while other things have gone down, and it's just exceedingly cheap. So, like I say, I'm just restating same things I've talked about. They report this week. holding all of it into the report, not going to hedge it. I'll probably hold it to the next 3 reports. So I probably won't do much on this stock, frankly, until it's 250 to $300.
What would you do on the downside if it comes down to it?
I mean, I'll probably keep chipping away at it. I've kind of got a semi-full position right now, so I don't know if I'd really need to add a whole lot to it. But I might keep chipping away at it with trading gains and things like that. But I kind of like where it is right here. Yeah, I'll just let it work, basically.
Yeah, I was trying to look at this one on a weekly and a monthly chart to see. Not, it's really tough because there's no good trends per se. Maybe on a monthly chart you can make a case, but it looks like it's on the verge of breaking down from a trend line that was established maybe back in the late 2008 time frame. Uh, so you could definitely see where it would pick up support though, pretty close to here to like 140. So I would imagine 140 would be a place where you might chip away, no?
Yeah, I mean, I have to kind of just see what that does when it comes.
Hmm.
But like I say, right now, I'm certain. I mean, there's literally I have zero concern, worry, anxiety. Again, this is once I latch into a cheap stock, I'm pretty content to just sit in it for a while. There were a lot of people who had big concerns about Acacia when it was a $30 stock. I never had any. And that's fulfilled nicely. Twitter, I mean, pretty much. I mean, again, my whole focus list, a bunch of names I've removed for price appreciation. I probably every one of those was down. I don't think I had any of those names that started off gangbusters from day one. So, I don't like I say when an exceedingly cheap stock gets cheaper, I don't get bearish on it. I get more bullish on it. Unless something changes. Baidu probably isn't going to change much. It might change in a decade, but Baidu is not going to change much from quarter to quarter. It's the Google of China. Just like Google's not going to change much from quarter to quarter. 10 years, 15 years from now, might there be challengers to Google's dominance? Sure. Maybe even a half a decade or something. But once these companies kind of become industry leaders in their respective area, they don't really change much. The only thing that changes on them and can change a lot is valuation. I mean, look at the valuation difference of Qualcomm now, right? The company hasn't really changed much at all. In fact, one could argue it hasn't changed at all. But the valuation sure has changed a lot, right? Same with Baidu. I mean, 4 years ago, just to re-articulate my thesis in a minute or less, you're basically getting the last 4 to 5 years of growth from Baidu for free. In fact, you're getting them for a discount. Because the stock has doubled in size in the last 3 to 4 years just on growth. And 4 years ago, you would have paid $240 to $260 for it, and today you're paying $150. So you're getting a company that's twice the size it was 4 years ago for not quite half the price, but like, I don't know, 38% cheaper. That's not a hard long for me to own. That's I'll own longs like that all day long and for the rest of my life.
All right, on
It'd
that.
be like buying Google at 450 or something like that. It'd be like buying an Apple where I bought Apple in 2013 when it was trading 2.5 to 3 times net cash. So you don't get too many of those, by the way. They don't, and most of the time when you get them, there's usually a negative narrative. There's usually people are concerned about things that they really shouldn't be concerned about. So there's usually kind of a false narrative, negative narrative. It's whatever people need to do to explain a price that doesn't make any sense, because human beings need to rationalize things that don't make sense. A lot of stock prices most of the time don't make sense. So most people do way better if they inherently said, look, I'm going to look at a stock price. 95% of all stock prices on any given day I'm looking at are irrational, as opposed to the efficient market hypothesis, which is complete, horse whatever. So, stocks are highly inefficient. Prices move in highly inefficient manners. The valuations of very large companies that change very little, not from day to day, but from year to year, the valuations of these stocks can change 50 to 100%. in relatively short periods of time. That's not price efficiency, that's price inefficiency. So that's what I look to take advantage of.
All right, on that same tune, why don't we talk about Alibaba a little bit? Because this one seems to be well, you compared Baidu to Google, and from a valuation perspective, is there a case to be made that Alibaba is cheaper in a valuation perspective to Amazon, and in that case, this one being cheaper?
I haven't taken. I used to like this company. I liked Alibaba a lot between like 65 and probably 100, and that was a number of years ago now. Probably the lows, the 2016 lows. I thought Alibaba was very compelling. By the way, this I think we talked about this. A very similar setup to the recent correction we're in happened in 2014 when Alibaba IPO'd. So that was spring of 14. A lot of software stocks were very expensive. Alibaba came public and you had a pretty good correction. So, it's kind of funny how history repeats itself. As far as like, I'm sure Alibaba's cheaper than Amazon, but honestly on like metrics, on all the financial particulars, I'm not sure because Amazon's not an expensive stock. I think the thing with Amazon would be how much of a tailwind do they have remaining? Are you buying a company? It'd be sort of like looking at Uber now. I mean, Uber, what a great investment if you could have bought it in the private market when it had a valuation of $1 billion or less, right?
Hmm.
Well, at evaluate now, the public markets have effectively cut Uber in half. They were talking $120 billion valuation not just a few weeks ago. It hit 62 billion yesterday. So Amazon in the public marketplaces, like how much juice is left in the tank, basically. Where I could think you could make a case. So this is how I would line up Alibaba. I just think you probably have a lot more runway for growth and more years of runway for growth with Alibaba than you do with Amazon. Metric to metric, valuation to valuation, I don't know if Alibaba is much cheaper than Amazon. Again, when I know, I always tell you I haven't done a deep dive on those two particular stocks.
All right.
They're pass-through companies too. What I mean by that is, they generate massive revenues, but they don't get, they're just taking pennies per transaction, so to speak. So, they can have these huge revenue bases, low margin. Things like a price to sales ratio, which is relevant across lots of areas of tech, is just not as relevant to companies like eBay and Alibaba and Amazon. It would, if there were 20 of these you could measure them against, then you'd have a pretty good comparative group. But you only have like 3. I mean, there's Alibaba, there's Amazon. I guess you have Meli in Brazil. You have, you have eBay. But then they also have big investment portfolios and all sorts of other things, so it kind of muddies the water. So you have to look at other valuations. Like I say, Alibaba would probably have to. I mean, I was looking at it in December. I was looking at Alibaba in December, but I kind of hitched my horse to the to Baidu, and I'm fine doing that. And beyond that, I don't need to. I don't need to spend much time looking at Alibaba. It's just not one. I'd rather own 5G names. I'd rather own some cheap semis that I own. It just doesn't. It doesn't kind of come across to me as something I feel compelled to do a lot of work on at the current price.
All right, so it sounds like you're okay with your overall positioning right now, but let's talk about some new setups you might have up your sleeve.
Yeah, I mean, again, I'm going to go back and kind of talk about or look at, companies that I think had very, very good earnings report. I mean, Acacia is interesting. I mean, I don't buy a lot. I don't typically buy a lot of stuff that I'm already up, big on, like 2x or more, or close to it. And so part of it is kind of the tax implications. But because if you're muddying the waters with a low cost basis and you're adding new shares, then you sell them for a trade, you're basically monetizing low cost basis, long-term gains. So that's one issue, not to get too tied up in that. But to the degree that I don't want to pay taxes, that's the longer you can defer gains, the better. But as far as a report that I think was a very good report, 44% growth. Valuations are still pretty attractive. I mean, even though the stock has roughly gone 2x from lows. Well, at 60 it was 2x from lows or more. But you still have pretty rational valuations. You still have a nice growth rate. I think some people, there was one negative analyst note on Acacia which talked about, well, they still liked them and they saw really good quarters, but they were going to an equal weight because, after 3 or 4 quarters, they weren't sure how much is left. And it's like, to me, it was kind of a weak call. But the bottom line is, I wouldn't say there's 3 good quarters here. That they at some point they will get a really good short-term bump from Chinese builds and Chinese deployments, and they're definitely in the mix for that. That will be a lot of business over a short period of time, but that's not the reason you own these guys. You own these guys because they roughly have a 2-year lead, maybe even more now, arguably, in bandwidth infrastructure solutions. So, everybody else now is starting to talk about how exciting 400G is. Acacia's already working on 800G and beyond. So, but the very good report. They guided in line. They also guided they reported right about the time, I think, that I made that correction call. Might have been on that day. They might have reported on that Wednesday that I thought, look, things are nutty. We're too expensive. Cloud stocks are nuts. We're going to correct. And so, a lot of times where a company reports in the quarter has way more to do with how its price reacts than the numbers. In other words, if the companies that reported early this quarter had a field day, I mean, there was a 3-week period where every report, even if it was relatively crappy, went up. And good reports went up a lot. Well, now we're in the tougher part of the quarter, at least for a while, or we certainly have been the last week or so. And most of the companies that reported really good reports last week or so have had a hard time going up on them. And so Acacia is a good example of that. And actually it held fine for about 2 days. I mean, I actually thought it would drop more the day or two after it reported. But what Acacia always does, it always drops a lot when the market drops. And so it's like a levered, it's like the beta is very high, especially in down markets. And so, basically went from 61 to 51. So for people inclined to participate in fiber optics and 5G plays, I think it's a very good name. I don't know if I'm going to buy a whole lot more of it myself, but just because I have a low cost basis. But I like it. I like the name. I think it's kind of silly. It's down as much as it's down just based on, on numbers and stuff like that. And hey, you get a 20% haircut on the stock, valuation's even more attractive. But it's hard to find stuff that's producing year-over-year growth of 40% in this space. Most of the incumbents are more like 7 to 15% growers, if even that high. So, this is basically the star of the space. So, and my price target's notably higher. Another one I'd point out is IIVI. Same thing, 34.5, 35.5 is pretty darn attractive for this. They did guide a smidge lower, a very, very little bit lower. But again, 16% grower. Went down in their report versus, Microsoft was a 14% grower and went up quite a bit on their report. And IIVI is going to have a lot more growth than Microsoft's going to have. So, plus they're getting very close to finishing or combining with Finisar. So I want to say, in fact, one of the last days to make an election on how you want to how you want to convert your Finisar is coming up here. I think by early mid-June, you'll have a combined company, and I think you'll have a pretty compelling valuation growth thesis there. So yeah, good report. Stock went down. Pretty easy call. And then the last ones, I think MTSI is kind of a no-brainer again, and this is kind of exactly what I've been waiting for. You got they had a nice spike. But I almost wonder if some of that spike wasn't a smidge of short covering. But they've repealed not all the gains, but a lot of them. Stock went from 12.50 to almost 17. Midday yesterday it was 13.75. It's bounced a little, but this is one I could pretty much anything below 20. It's viable for me for my long-term thesis. anything at 15 or below is, really, really tasty. So, and this is one I work a lot of trades on this name. I post my long-term ads, but yeah, I basically can buy this any given day. If it's under $15, I might be trading this name. And then kind of slowly building my position a little bit further. I got pretty close to a full position. But that's another name that, again, but what was interesting, this is kind of my thesis. It went up huge on an okay report, but wasn't a good quarter. But you know how I feel about stocks that actually go up a lot on kind of, let's say, call them muted to bad reports. The thing about the report, the numbers weren't great, but the commentary was very good. So a lot of people don't listen to conference calls though. But if you listen to that conference call, it was a lot of positive commentary. In fact, MTSI's thesis, or what they're saying, is they think they're coming closer to the end of their data center woes. Other people aren't echoing the same thing. So it'll be interesting to see, but they don't exactly have the same customers though either. So maybe their particular data center customers were a little earlier into the decline. I will say MTSI was one of the first companies to warn about data center weakness, while other companies were still trying to say, oh, data center's fine. They were at least a quarter or two ahead of everybody else. They still need a China deal, but the China deal is basically pure bonus whenever they get it. And if they don't get it, then everybody's going to have to deal with higher tariffs and stuff like that, and recalibrate to the new condition set. But the amount of business that is going to need to get done still needs to get done. It's just sort of been deferred. So I'll stop it there. But again, this is every one of those names fits into my 5G fiber optic thesis as well, which is, I still think that's the new growth area, or the new leadership group. I think the old leadership group is still trying to hang in there. But I think once we fully, probably through each correction, I think you'll see 5G act better, probably Cloud and FANG act worse. And really, FANG hasn't really been much of a leadership group this year. It's really been cloud leadership. But yeah, by the way, there's a lot more, but those are just three. Those are three examples. So I would basically say, look, go back, look at what companies that reported well, and maybe spiked and then gave a lot of the gains back. And I think there's quite a few things that you can nibble on right now. If you don't mind where the market is. I still don't really love where the market is, but that doesn't prevent me from doing certain things.
All right, and why don't we touch on LYFT? This is one that you got involved in. When was it? Last week, or I can't
No,
remember
I mean,
exactly.
I've been kind of nibbling around it. I mean, my best lift trade actually was from my highest cost, because my best lift trade was actually from, like, I don't know, 67 to like 70 something, and pretty much since then it's pretty much been horrible. But this is small, kind of been toying around with it. So never put much money into it, so it hasn't really cost me much. At the same time, I've never really worried about it. And I almost kind of think this one kind of got crazy. Every now and then I talk about basically about just crazy action, stupid action, price dislocation type stuff. I would almost say that for LYFT in several ways is almost price dislocated. Now, somebody who's won't buy a company until it has profits. Well, you're not even going to look at a LYFT. And by the way, you weren't looking at Okta when it was $26. You weren't looking at Coop at 25, and you weren't looking at, Nutanix at 15. So if you have to have profits or a profitable company to buy, then most tech growth companies aren't in your bailiwick anyway, right? But if you don't mind growth companies selling at discounts or selling with big haircuts, hey, I mean, but this kind of fits my thesis too of really good quarters. I mean, they had a really good quarter. I mean, so I'm a little surprised, but not really, but I am a little surprised that maybe the stock went down as much as it did off that quarter. At the same time, I guess you had a lot of people shorting LYFT until Uber started trading, and maybe they're still keeping their LYFT short going because Uber's going down. But I think the main bear case, which was, okay, we short LYFT because of Uber, I think that's probably gone at this point because Uber's out. It's trading, going to do its own thing. If you want to short Uber, you can short Uber. but this is still kind of the structural trade. The whole reason I've kind of been interested in this thing is still there, which is that yes, this is a fairly large company market cap wise. It'll eventually have a lot of shares outstanding. The current float is very, very skinny right now. So I'm not sure if if I'm reading this correctly. Now, this is one of these things like, how can this happen? Well, it happens because naked short, but it looks like there's more shares short than the available float currently. And I've seen oddities like this before. But at some point, I don't think it would take much for LYFT to put in a pretty big move just because you have a very, very skinny float. And obviously, the float's going to get bigger. They're going to have the IPO lockup, and you're probably going to have secondaries over time and things like that. But right here, right now, to me, if somebody short this name, to me, this looks like a very dangerous short. Just because you got a very skinny float, you got a very high. Again, do you have more than 100% of the float short? That's what the numbers look like. Again, I'm not an expert on short float percentage, but this just looks. I've seen things like this before. Yeah, so you got a crazy high short percentage here, and you got a good quarter. And LYFT is definitely the company I think that that has more growth runway than Uber does. So wouldn't surprise me if it finds interest with like value buyers and relative growth buyers and things like that. And the price to sales ratio, especially on out year, is pretty tolerable now. You got a $14 billion company. My revenue run rate on them is about $4 billion. That's out year. That's an out year number. Heck, you're talking 3.5 times sales. So that's not bad. Plus, you had a downgrade on it today, or a lowered price target. I always tell people to look for bottom ticks and top ticks. I think that downgrade call, or whatever that call was, I think it could serve as a bottom tick. So I think the setup for LYFT for a move back to, I don't know, I think something at least like 63 to 65 is pretty. I would say there's a very high probability stock gets back to 65. And then once it starts going up, I think that the move's going to be pretty quick. But I don't know exactly when it's going to go. But I think once it decides to break and go, you could get a 3-day to a 7-day move where you cover 15 points in a hurry.
Interesting. I didn't see the target change on LYFT, so I'll have to check that out.
Yeah, there was some guy, he's kind of been a bear on it. Hey, he's been right, but I think he lowered his target from like 42 to 35 or something. Sometimes it's just better to declare victory. Sometimes it's just better to say, hey, I said it, I didn't like it. Hey, it's fulfilled. I'm out now, right? But most people don't. They kind of like, oh, hey, it's going lower. I think it's going lower. Oh, look at the charts in the bottom right corner. It's going to keep going lower. Just like, people, oh, hey, it's in the upper right corner. It's going to keep going higher. Some people aren't as good at getting off of a call. That probably takes as much skill getting off of a call as it does making a call. So, and it's typical for analysts to do it. They kind of ride the horse until it either dies and falls over, or they try to ride it into the ground, and it gets up and gallops and it bucks them off. So, but yeah, I don't love LYFT. I'm never going to make LYFT. Well, I shouldn't say never, but for now, I'm not going to make it a big position relative. Most other things I still like a lot better. But for a trade long setup, I think it's actually one of my more compelling short-term to intermediate-term longs right now.
All right, and any interest in Uber?
No. I will say it's already got the 50% haircut from private market to public market, and that happened pretty quickly.
Yeah.
So it's a hell of a lot better buy at 60 billion market cap than it was at 120 billion market cap. But this is kind of this whole thing about, this is why, like, I wish we had a thing like the old uptick rule. Leon Cooperman was on CNBC a few days ago, and he and I are in very, very like violent agreement on certain things. Uptick rule should have never been repealed. no specialist system anymore. I could go on and on and on. I love the algos. I love the fact that we have a world of algorithmic trading because it's the target set is so much bigger for me than it was years ago. There's so many more names to be long. There's so many more names to short. There's so many more stocks get to extremes today than I think ever did before. But at the same time, it's not the most healthy circumstance for markets in general. And I think that's part of the reason that you don't, hey, way back in the day, companies like Intel and Microsoft were worth hundreds of millions of dollars when they went public. So public investors got to ride a really hot growth stock for decades. Nowadays, it's very, very rare. I mean, by the way, it's one reason I love Redfin so much. I could be wrong on Redfin. I don't think I will be, but I could be wrong. But the thing I like about Redfin is basically like a poker deal. It's pot odds. So if Redfin does work, it's not just going to go to like 24. It could go to 124 or 224. It could go 10, 20 bagger, because the beauty of Redfin is they went IPO at a very early time in the company's history. And if they're successful, it will become a way bigger company as a public company. By the way, just like Splunk did, just like Workday did, just like Now did, just like Palo Alto, and I could rattle off a bunch of software companies. The problem with Uber, they went from 0 to 120 billion in the private marketplace. Is there ever really a reason to buy it? I mean, yeah, put it this way, I guess there's a reason to trade it. It's not an uncompelling valuation, honestly, right now. 60 billion valuation. What are they going to do? 12, 13 billion in revenue this year? I think 11 billion plus is already on the books. I mean, on a price to sales basis, given the growth, this is pretty cheap. Again, it's a jobber. It's an intermediary. It's, again, their revenues are much higher than margins are, because it's kind of like an Amazon model. But hey, you still do have 11.3 billion revenues on the books, and that growth rate's pretty high. $60 billion market cap, a lot better than 120. I like LYFT a lot better personally, but yeah, I don't know. I mean, 30. I might, I'm gonna see what the chart does. It might become a decent trading name. But from a growth perspective, from my disciplines, my valuation disciplines, things like that, I think LYFT sets up that. I mean, I think the price sales on LYFT is like half. So especially on growth metrics, I'm getting LYFT at like a 50% discount. So I'll take a company with superior growth and 50% relative valuation discount pretty much all the time. But yeah, I mean, Uber, I don't I guess what I say about Uber, the most bullish thing, I don't think I'd short it. So, I think the guy shorting it, good luck. I don't know what they're, I mean, it's already had a 50% haircut from 120 billion. 120 billion is probably pretty kind of crazy, but I don't know. I mean, what are they trying to do? Get the last 4 points out of it or something? I like shorts where I can make a lot of money. I don't really want to short where my upside's like 8 to 10%. That doesn't excite me very much.
All right, Sean. Well, we're probably going to wrap this one up, but do you have any parting shots that you'd like to get out there? Something that maybe we didn't cover?
Well, yeah, Pinterest, I don't have any. Now this, if there's one that I literally almost bought it yesterday, not really for a bounce trade, but I wanted to own some into the print. They report Thursday. Mm-hmm. Damn, it's up $1.90 right now. I'm not going to chase it, and I'm not going to buy 28.50 to 30 into the print. But 26 and lower into the print felt pretty good to me. I think analyst estimates are pretty conservative. I think they probably post a pretty good quarter. Yeah, this is one kind of hurts, but because I probably should have added to it yesterday. I guess sometimes sometimes my disciplines preclude me from doing a trade. I was really kind of wanting 26 or lower. I think the low yesterday was about 26.60, 26.50. Sometimes trying to save 50 cents costs you a few bucks. So. But yeah, I do like that setup into the print. I'd like to, you never know, maybe I'll get lucky. Maybe the market will fade later today. Maybe I'll have a sell-off. and it'll give me a better entry between now and when they report. But again, I literally was going to buy it yesterday as basically a pre-print trade for Thursday's print. I'm not sure I'm going to do it now, but I do think that for people who are more like momentum or something, hey, maybe that works for them. I think they'll have a good report. I think they'll have a report other people will think is viable. But I just don't chase stuff. There's so many things I can buy. You know what I'll throw out? I'll throw out Vicor. I'm looking at Vicor again. Um, so
VICR, is that ticker?
this yep, VICR. Everybody seemed to love it at 38. I kind of backed away from it. 3350, a lot more attractive. I'd really love it in the 32s. Probably wouldn't take much to get it to drop another 50 cents to a buck. But that's one I could at this price or lower I could nibble a little at for sure.
All right. Well, that gave us some good things to consider here. I know you like STNE, and good analysis of why you like Lyft over Uber. And this will give us a lot to circle back on next week. Earnings season pretty much out of the way. Any retail names or anything that you're looking at?
Not real. I'm still focused on tech. This is a very light week of earnings. There's still going to be a smattering of reports though through the week. I mean, we got Nvidia Thursday. Obviously, Baidu. Baidu's the last of the last of the reports of names I have. I guess significant size would be Baidu and Cloudera. So pretty much done with all my bigger names personally. Baidu and Cloudera are the only two remaining. So that report has interest. Again, I'm not sure I'm going to do much on it. If it pops enough, I might trim some. But yeah, it's still, I'd like it to get going on a good multi-quarter run. I'll probably start working on next week's reports next week. I'm going to have a focus list update this Thursday or Friday. I don't know if I have any name changes though. Maybe just some mild price target updates. I don't know if I have any new names in my focus list. But there might be a mild update, some comment updates and things like that. But yeah, I'm not looking much at retail. Now, in the past I've looked at retail when the stocks are really, really washed out. I don't know if the bargains that, when I first came on the briefing platform, retail was crazy cheap. I haven't seen any kind of crazy bargains like we saw a couple years ago. So right now, I mean, there's just plenty of stuff cheap in tech, and there's plenty of potential short candidates, especially if we pop much more.
All right. Well, as always, Sean, thank you for joining us today and giving us some ideas, some updates, and whatnot. So, as always, we'll see you again or talk to you again next Tuesday.
Take care, buddy.
Hey, you too.
All right, see you.
All right. So you heard it from the man himself. He's saying this correction is over.